This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perney, and we are pleased to welcome on Brad with Sugar House Investments. Thank you very much for being on with us today, Brad. Give us a little bit of your background. Most people that are on the podcast, especially that are involved in real estate, typically, doesn't just go to school and get a degree in real estate. They have kind of an interesting background of kind of how they landed in what they're doing in real estate. So give us a little bit of your background and kind of how you came to be with Sugar House Investments.
Yeah, maybe I bucked the trend a little bit because I actually did go to school with the idea of going to commercial real estate. I did a finance degree as my bachelor's, but then right along suit with what you're talking about, I left. I left that path. But yeah, I actually did a college my internship in between my junior and senior year of college with a large commercial acquisitions firm up in Seattle. But by the time I graduated that next year after my senior year, I went a completely different route. However, even on that route, we still had our hands tied into real estate consistently, whether it was we were doing vacation rentals, we were doing some development of hospitality and retail suites, but as a kind of a side thing from the main operations of the business. And then me personally, I bought my first rental about 6 months after I graduated from college. Once I realized my path was going a little different direction, I knew I still wanted to build up my own portfolio. So that was 2002 was when I bought my first rental, and then had my hands in some stuff. We were renting out large like family reunion cabins in Park City area in Utah, some stuff back east, and then we moved to Texas in 2011. My wife and I did at that point, and there I did some more like fix and flips and some wholesaling, and realized not for me. Right, that wasn't the place where I wanted to hang out. And so 2016-ish is where I started thinking about, well, how do I get back to commercial? I like that. That's what I originally had wanted to get into. And that led me into this world of syndications. I invested in my first two deals passively, just as a typical LP. Really liked it. Started getting the idea of like, well, I want to do this myself. I want to be a GP. Started, kind of going down that path. But along that, in those efforts, learned about the opportunity to partner with some of these GPs and helping them raise capital. And for me, that was a light bulb moment. I felt like that suits my strengths really, really well. And in 2017, I started Sugar House Investments and have been focused on those efforts since.
Well, that's really interesting. I think you're probably, I'm gonna go on a limb here and say you're kind of the first person that really had the, drive to go into real estate directly from college. I went the finance and business route myself, and getting into alternative investments definitely wasn't kind of what I had envisioned. I come out of school and right on the tail end of the Great Recession in 2011, 2010, and
Okay.
it wasn't the greatest time to be hang your hat with finance and business and being like,
Right.
all right, everyone's not hiring. This is fantastic. But getting involved in the alternative space was very interesting. But it's always cool to hear when someone has that drive to be in this kind of from the jump. So also the interesting aspect of what you mentioned is that you really kind of found your niche in the the capital raising side of things. A lot of people that say, hey, I'm going to be a GP, they're typically more geared towards the operational aspects. They're really kind of the hyper focus. Okay, I'm more of the business side of wanting to do this, and talking to people that come in to from your perspective is something I really haven't talked to many people about, on that kind of coming in wanting to be a GP but focusing on the capital raising side. It seems kind of more often than not the people I talk to, they come in and become GPs, but they're they found their niche as the LPs on the capital raising side. So with
Sure.
regard to what Sugar House Investments does, let's get into a little bit of that. So I know it's kind of a little bit of a different avenue than kind of your general commercial real estate firm going out finding deals, plugging in. Tell us a little bit kind of how you operate at Sugar House Investments.
Yeah. So it ties in. I'll give a little bit of background here because it ties in a little bit to what you just mentioned and what led me to finding my niche and my calling here with Sugar House's efforts. My life experiences, when I graduated in end of 2000, middle of 2002, with a finance degree, and we were still feeling the effects of 9/11 and the recession that happened at that point. In that my senior year of college, I joined this little startup where I was employee number two, and by the time I graduated, I had a chance to buy in and become a partner there. And so, I spent my 20s with that company and all the things that come with being a partner in a small in a startup like that, the 85 90 hour weeks and the hiring and firing and the strategy and what do we do with this thing. We eventually sold that company in 2009. I felt like I checked off the entrepreneurial box at that point. I was like, okay, I've been there, done that. It's a lot of work. So when I was getting in, when we moved to, that's kind of what precipitated our move to Austin a couple of years later. It was like, all right, what do I want to do now? And I started doing the fix and flips and the wholesaling, and you can do that as a lone wolf. You're not responsible for employees and payroll. Once I started looking at the GP scenario, it's clear that that's not a lone wolf operation, right? You've got to put a team together. No GP operation is successful. You've got to have part of the team that's great at the acquisitions, part of the team that's great at the finance, part of the team that's great at the operations, et cetera, and the investor relations. So it's a big lift, right? A big responsibility. When I learned of the capital raising side, I get to partner with these teams that are already established. They already have the systems in place. They've got the teams and the team members in place. I get to bring my component, and I don't have to have the 80-hour weeks and the 90-hour weeks. My responsibility is to my segment of investors. I'd have to spend a lot of time with the operators, but my responsibility is to my direct investors. And I can do that with my wife and me, and we have a couple advisors behind us. But it doesn't bring all the responsibilities that the GP has to take on their shoulders. So again, from my life experiences, where I'm at with my mid 40s, couple of really young kids, I like this role as being really suitable to again, from my life experiences and life position now. And so that's the focus. I work with those LPs or potential LPs who like the idea of commercial real estate or owning real estate in general, but aren't really exposed to the idea other than, being a landlord or being a flipper. So it's really fun to get to educate the folks on what, hey, that apartment building or that industrial building you drive by and day in and day out. It's regular people like you and me that own that. Did you know that you can participate in that? So that's really fun.
Yeah, absolutely. And to the point of the grind culture stuff, I think I was employee number 8 here at Advanta, so I can commiserate with some of those long hours. It's definitely
Right.
nice to be in a position where you're not doing that anymore. But
Yep.
there's something fun to reminisce about. It's I enjoyed that time, but I'm glad to have a little bit more bandwidth. So
Right. When you wear all those hats, you're making strategic decisions and where does the company go from here at 1 minute, and then at the end of the day you're taking out the trash, right? It's just
yeah, it's
do.
it was a fun time, but it's been really interesting to watch us grow and the different markets that we've kind of come to align with. And back then it was just basically kind of a hyper focus on real estate, and since then we've grown into getting clients that want to invest in private startups, different kind of interesting alternative investments, and really kind of the whole spectrum has been really fun to watch. Now
Yeah,
I could commiserate on my past decade doing this till the cows come home. But specifically to kind of what I wanted to talk to you about, you mentioned that there's kind of 3 buckets, if you will, that the commercial real estate space, at least that you're dealing in, kind of is looking at. So we have the commercial multifamily side, so think apartment buildings. In the commercial space like that. And then also the other 2 that you mentioned, correct me if I'm wrong, but it was self-storage and industrial, correct?
correct.
Yeah.
Yep.
So, looking at the differences in, we've covered commercial real estate a lot in a lot of different avenues, but one thing we haven't touched on really is the industrial side. And that's something I find very interesting because the value proposition and the cash flow proposition for industrial real estate is wholly different than what you look at with regard to commercial multifamily, where you're looking at, what's the value add proposition? How do we get vacancy as low as possible? You're dealing with, potentially 2, 3, 400 tenants in one singular location. So
Right.
again, the value proposition and the cash flows are looking significantly different than what you have for self-storage and what you have for industrial. Now, obviously, the differences between industrial and self-storage are going to be a little bit different. Are going to be different from each other I would say, correct me if I'm wrong, but the self-storage and the commercial multifamily probably have more in common than either of them do with the industrial side, correct?
Yes, I agree. Both are very operationally heavy.
Yeah. So, with that said, let's kind of take again, top down, from the capital raising perspective and the investor perspective. Let's kind of again just give a brief synopsis of what it looks like for the commercial space with regard to the multifamily and the excuse me, the self storage, and then that way we can get a really good comparative analysis going to what it looks like for people that want to maybe get exposed to the industrial space. So, if I missed anything on kind of my synopsis, what does it look like from you? If someone were to come up and say, hey, explain this kind of at a high level to me, if I'm investing in this, what does that mean exactly?
Yeah. Most people who have invested in syndications or for the first time LP, multifamily is a great place to start, right? We've all lived in an apartment. Most people have lived in an apartment at some point. We understand that the business operations of that. In very simplistic terms, most apartment syndications are a glorified fix and flip, right? It's the same concept. You buy a property where you see some opportunity to improve it with the idea that you're going to be able to resell it later on for more than you paid for it with a handsome gain. Same idea as a single unit fix and flip. It's just a glorified version of that. Takes a lot more dollars, takes a lot more time, takes a little more sophistication, but it's the same principle there.
Yeah.
And then with self storage, it's you increase the operational lift quite a bit because now you're talking about monthly leases, resetting prices daily based on what's going on in the neighborhood. But again, it's the same principle, is that you're looking to buy that building, optimize it, bring in some technology, redo the parking lot, and then you could resell it later on after you've enjoyed several years of cash flow, resell it for a significant gain. The industrial side, this took us several years to find a partner in this space with a model that we really liked. And so we at this point we do just have one partner that we work with raising for this. And this model, I think it suits really well, especially right now, where in the multifamily space, and even now in some self-storage deals where the distributions have been paused because of the interest rate scenario and the market that's going on there. Where the industrial side, what we're talking about is really manufacturing heavy type operations from companies that most of us had never heard of before, but they're doing a lot of business. So the model that we're working with is buying these buildings that are exclusively single tenant operated, and so there's your risk, right? It's a single tenant risk, but we're working with companies who do at least $100 million a year in revenue, large organizations. They're doing things like the plastic that goes inside the glove box in a car, or the tank that goes underneath the gas station. These weird random things that are essential to our everyday life, but we just don't. They make a part of the motor that goes on side, Bell helicopters or something like that, right? They're essential and they do a ton of business. We're just not very familiar with them, and because they're heavy in that manufacturing operations, they've invested a ton of money into that building. They don't want to leave, but for one reason or another, they do need a cash injection, and so we're doing sale leasebacks as in this model, meaning that firm is going to sell us that building and stay put. They currently own it. They're going to sell it to us. They get that cash infusion, and now they become a tenant of ours in a very true absolute triple net lease with set rental increases. And so that structure allows it to be a very predictable cash flow model. There are a few, more limited, but there are a few value add opportunities that may or may not come on the life of that lease. So it is really a cash flow play. But because we know that tenant, if they want a new roof, if they want a new HVAC, if they want a new parking lot, they are on the hook for that and not us. And our rental increases are predetermined in the lease for the next 20, 25, 30 years. And so we know exactly what that cash flow is going to be. The taxes don't impact us. The CapEx doesn't impact us. And so I can tell the potential investor, if you're looking for cash flow that's going to outperform the treasuries and the other bonds that you can get right now, you want to outpace inflation. I've got a really good cash flow play for you that's not subject to the interest rate risk that we're dealing with in the multifamily space. Maybe it's not going to be the grand slam, but this is going to be a really predictable cash flow opportunity, renting from or renting to these very large established organizations. And the partner we're working with, they've been doing this for coming up on 10 years. They've only had one tenant ever default on a lease, and that was because of a bankruptcy scenario from a very strange, unusual event. But even in that bankruptcy proceedings, the judge ordered them to continue to pay the rent to our partner here, and so they continue to receive that cash flow. And so it's been it's proven to be a really safe approach when especially in a market that's bumpy or frothy in the scenario we're in now.
Sure, great. So I just I'm taking a few notes here now. When it comes to, again, a lot of exposure that we've had on the podcast with regard to commercial real estate, the term triple net lease really doesn't kind of come up too often when you're talking about, individual people renting out apartment buildings. So
Right.
maybe let's give a little bit of a definition to our listeners if
Okay.
they haven't heard that, or maybe just kind of, they've seen it on something I've taken. What exactly does triple net lease mean?
Yeah. So what it should mean, and it gets tweaked every, so you have to dig in. But essentially what it means is the tenant is responsible for everything to do with that property. I'm the owner of it. I pay the mortgage, but the tenant pays everything else. They're paying their monthly rent. They're paying utilities, the property taxes, anything that needs to get fixed. It's on them. If they want to add some space, they have to, we have to sign off on it as the owner, but they're going to be on the hook to modify it. If they want to bring in, a different assembly line, and they need to reconfigure the internal layout, it's on them. So it's, lots of buildings work this way, that the Arby's down the street, the Chick-fil-A building, it's the Subway, those are generally triple net leases, though sometimes those lease terms allow for some leakage that may flow up to the owner. These that I'm talking about are absolute triple net. So nothing can leak up to us other than our monthly mortgage on the building. So that's the general definition, is that in triple net, the tenant is on the hook for everything to do with the ongoing operations repair of the property, including the taxes.
Would you say it's kind of fair to assume, at least when people are kind of branching out of the commercial multifamily space, when you're getting into the commercial industrial space and even light industrial, like you said, something like an Arby's, a Chick-fil-A, places that are going to be single-use occupants of a commercial piece of real estate are typically always going to be on a triple net model,
Right.
to varying degrees. But typically that's going to be the use case when people kind of branch into this segment of commercial real estate, correct?
You're right. In that commercial industrial, the triple net is the most common.
Great. So now you mentioned that, you're looking at people that are doing X amount of revenue. Is there any insight in kind of, the different types of tenancy that you see? Is 100, obviously it's an arbitrary number that's assigned to kind of a size of company, but is there kind of some reasoning behind it? Is like, once you get to people that are doing 100 million of revenue, is that generally, people under that kind of filter in with just is it not as stable, or is it just kind of the scale of the operation, the size of the building, the amount of cash flows that can be realized, and maybe kind of the propensity of people doing that to utilize a property in a certain way? Obviously don't give away any secret sauce, but is there kind of
Sure.
a reasoning of, why you kind of stuck the $100 million of revenue figure on the kind of places that you want to deal with this investment structure?
Yeah, one of the thesis that we work under is that at that size, they've got multiple locations. We don't want to go buy just their only location, and then that's a location they could walk away from at some point and expose us to that risk. So, the typical group that we're working with, they have 8, 9, 12 locations. We'd have to do, because the biggest risk here is the tenant risk. We have to do a full evaluation of their operations. We're diving deep into their financials. And as part of that, we're looking at which ones, at a location by location basis, which are their strongest sites. And that's the site that we want to buy, because we know that they're not going to walk away from that site. They're heavily invested in that site. They're not likely to come and say they're going to shut down operations in that state, in that city, to focus on other spots. And so it's at that size, we know that we can be really strategic in which one of their buildings, locations that we're going to purchase. That $100 million, it's a sweet spot as far as they're not they're not public. These generally aren't public entities. They're still private. We can work directly with the controlling interests of the organization. So it's kind of a good sweet spot there for us. They're large enough. They've been in business for a long time. They've got a healthy pipeline. They've got a healthy clientele. Not too large where we have to get into mess of weeds or public disclosure issues, and then we can be strategic in which one of their sites we're going to be discussing with them.
Yeah, and is it something where you're, and maybe kind of go into a little bit of, why this might hold true, but you mentioned that are you typically always, or are you always doing leasebacks, meaning that you're buying from the people that operated it and then basically just turning it into a lease? Or do you ever go in and is there a bigger inherent risk to going to another operator, buying it from them that has this, again, let's say this avatar client, they're doing 100 million, they're a private company, they have multiple locations, or are you just kind of trying to focus on people that need that injection of capital, kind of to drive that interest in keeping that location? Because obviously they've been there, they've done the improvements, they know it, they've owned it. So that way, maybe it gives them a little bit more of a cushion to want to stay there to help mitigate some of that landlord-tenant risk.
Right. So for the fund, the opportunity that we have available to our investors, it is strictly the sale leaseback approach. It's a really clean transaction. We can see, we've got years of history that we can evaluate from that location. It's a tenant that wants to stay there. And it's a building that's been customized to their needs, and so it might be a little bit of a tricky scenario to release that thing when that time comes. And so we like the idea of that tenant staying put. The month after we've closed on the sale of the purchase of that property, we're receiving cash flow from that. So it's a quick turnaround into that cash flow showing up into our bank account. There is, a model of where, we could see, there's a chance to step in here and optimize this business. That's a whole other conversation. Do you want to get into the operations of the business? That scenario can come up. We've siloed that to another scenario, to another location. But for our investors, we're strictly talking about the sale leasebacks, not getting into the operations of the actual business that's within the four walls.
Yeah, and I would imagine there's probably a psychological component to that too. I mean, you're buying from the occupant of the building, they have an attachment to it. They want to stay there. They need capital. It really wouldn't behoove them to say, okay, well, we're going to sell the building that we have invested all this time and money and that we've owned, just to then turn lease and then immediately walk away from it.
Right.
There's a financial component and also kind of that, we like this building obviously enough to have gone into this type of agreement. Let's, stay here. So I'd imagine that probably plays, whether or not that's quantifiable is probably hard to say, but I would imagine that probably, at least in my mind, of thinking about how real estate works, with them being, real estate being many things, but cheap is not one of them,
for sure,
relatively speaking.
Right.
Having that a little bit of attachment to the property, whether that is psychological or just the fact that they built this thing for manufacturing is always highly specific and highly customized to that location. So having that there is probably important as well.
Yeah, and there's certainly some intangibles as you meet with the principals of the company. What's your strategy? What's the long-term plan? Why is this location important to you? We verify that all through the data, right? Let's dive into the financials to make sure that piece has to make sense. Otherwise, the intangibles don't matter. But there is an intangible component to it. But it's oh man, there's something I was going to mention there. It slipped my mind, so it'll pop in as we keep on talking here.
Yeah, absolutely. And something that also kind of, brings up, and thinking about a true triple net lease and something of this size, manufacturing processes change drastically, or sure, it can change drastically. The way that something is done 1 year might necessitate different equipment, so that's good. But what happens if they have to do a sizable capital improvement to the property? Like, let's say adding additional buildings onto that. Obviously, they're footing the bill in a triple net scenario. So how does that work with regard to your ownership of the property? Is there something that has to be renegotiated into the lease? Do you get additional rents? Does that, how does that kind of play in? Because if they're owning the improvement, like I said, they have to put a whole new, building on the property. How does that kind of work in this scenario? How does that play into the equitable ownership, increase in rents, negotiations on leases, things like that?
All of the above. So it turns out in this commercial industrial story, those opportunities where the owner or the tenant needs some major improvements, some expansion, so new system in place, those are actually our value add opportunities. So in this commercial leasing space, what makes a property valuable is a really strong tenant and a long solid lease. And so, if we buy a building and or if you sell a building and there's 3 years left of a 20-year lease, that's not as valuable as 17 years being left on that lease. And so when we take over this property, we're going to put a brand new 25-year lease on this deal. And then they'll say we get 3 or 4 years out, and they need some additional buildings. They need additional some kind of feature to that property. We'll actually finance that for them. We'll provide. We'll do it. We've got the teams to go in there and complete that construction. Provide the dollars for that. And in turn for that becomes we're going to reset the clock on the lease. So now they're going to be paying us back for the financing we provided. We've resetted the lease terms. Now that property has become that much more valuable with having reset the clock on that lease at a higher rate, with some financing components as well. And so that's not going to happen on every building, right? But when those scenarios come up and the tenant comes to us and says, we'd like to do X, Y, Z, absolutely. We want to entertain that conversation because there's a value add opportunity there for us, both in the lease terms, the length, and the financing.
That's really cool that you mentioned of how that kind of works, where it's essentially, you're carrying back, the appreciable cost and financing that into the lease. Now, is that something where it's then in turn, okay, you mentioned that, okay, there's a renegotiation, there's, the potential to finance that capital improvement for them. Now, is that going to be conjoined in with like a note that goes into this commercial lease, or is it all just packaged into a new negotiated lease agreement component? Because I would imagine there's also, again, potential and maybe opportunity for different revenue streams that might potentially be taxed differently coming back in, whether you have like note interest, whether you have, lease and, income, lease income from that derivative lease. How is that kind of packaged, or is it deal by deal specific on, how that exactly is put into place with, when it comes to quote financing those large capital improvements?
Yeah. So I've seen both scenarios where it has been separate, distinguished as a note in addition to the resetting of the lease length and the lease rate, but also kind of packaged into it as well. So it is deal by deal specific. It depends on the tenant's needs, how long, how expensive, how much money we're talking about here, the types of improvements necessary. That's all going to influence how we're going to need to approach it to make it make sense. Whether it makes sense to finance, a parking lot over 20 years, maybe not. But if it's, 2 or 3 other buildings, yeah, that can make sense.
Yeah, for sure. And I'm assuming it also is, a little bit of, back and forth with them to see like what their needs are, because when they're the owner of the property, their ability to cost segregate or do, accelerated depreciation on certain types of assets, whether it be, a parking lot versus like, a capital improvement to a building or new manufacturing processes, could definitely play into, their strategy of what they need to do as well. So it's cool that you have that flexibility, and it's not just kind of, again, canned into one, molded, scenario for the tenant.
Absolutely. Yep.
So,
yeah. And then the last thing I was going to mention is that we've structured this so that you can participate in this. I say play, because I like real estate. It's fun.
yeah.
But you can participate in this deal both as a direct owner, or we have a REIT option as well. So depending on you as the investor, your preferred tax treatments. We've got both models because we're gonna we structured this as a fund, and so that fund might own 10 different buildings in 10 different states. Now you as the LP are going to be responsible for state tax returns in a direct ownership relationship. The REIT approach with that REIT election allows us to treat it under one entity. You get one return. You as the investor don't have to worry about the state tax filings either. And so that's been a unique aspect to this fund model, where we've been able to solve that. What do we do about properties in multiple states discussion?
Great. And I'm going to put a pin in that because I definitely want to come into how the investor kind of ties into this. But I had a few other questions that I had jotted down on things that of just, curious things about, people that have never invested in industrial real estate might have. Now, industrial manufacturing, it deals with a lot of different stuff. And a big one is, dealing with the federal government and how you manufacture something, whether that's the EPA, whether that is land management, a lot of different things. One question that kind of popped into my mind is that when you go and acquire a piece of real estate, I know there's a lot of times, and I guess you're not necessarily changing, you don't have a change of use, which is good. It's the same process that's already been, quote, approved to be in that location. But is there ever an issue where the sale of a particular building that is engaged in some type of manufacturing, and I'm assuming this spans widely depending on what they're doing, if you're involved in a lot of petrochemical stuff, it's going to be way different from something else. But does the acquisition transaction ever trigger something where you have a big headache that, the EPA comes in and says, hey, this has to be brought up to a certain standard? And does that also kind of drive the investment thesis away from certain industries? Like, do you just say, hey, you know what, we don't want to touch pesticide manufacturers, or we don't want to touch, plastic manufacturers? Is there anything that plays into that like that? Or because there's not a change of use, do you not run into many of those?
No, that is a consideration, and that's a fantastic question. Like if you're going out and buying a strip mall and a closed dry cleaner in there,
Mm-hmm.
huge consideration, right?
Yeah.
What chemicals have they used? 1 ounce of that, whatever whatever that chemical was, 1 ounce
Yeah.
of that ever spilled, that property is doomed for life. It's done, right?
Yeah.
You don't want to touch that with a 100-foot pole. So that is part of the thesis as well, because when we go to resell, that's the exit plan here, right? At the end of the day, these are all flips, right? We're eventually going to sell this building for more than we paid for it. That's the premise, right? And so knowing that's the end game, we know at some point that's a potential. Having it have to do with some those environmental studies on the property, and so the approach for us is let's just steer clear. We're talking more about metallic manufacturing and other lines that are going to be, I'm not saying they're clean, but they're not environmental contaminant type, dry cleaner type concerns.
Yeah, you're talking about having a huge machine shop that's making, parts for rocket nozzles versus someone that's making, plastic derivatives or petrochemicals or,
Right.
stuff like that.
Yep.
I kind of imagined that was the case, but it's just one of those things that, it's not something that you really think about when, there's not a dry cleaner on site with an apartment building. There's
Right.
not those kind of considerations that you have to do, even though there do have to be, environmental impacts, and there's, different stuff that you get into a little bit with that. Definitely not the case when you're talking about heavy industrial usage.
Yeah. So I mean, if they've got a waste product that's going to have to go put in a barrel and they have to bury it and it's got to be watched over for 250 years or whatever, like, all right, that's not for us, right? Let somebody else play in that world. That's just too much going on. We just like the straight cleaner version of manufacturing operations.
Yeah, and before we kind of get into the investment side, one other question I had that we touched on a little bit is length of lease. Obviously this is a buy leaseback scenario, and these are significantly longer leases than probably a lot of people are used to. You might look at a commercial lease for, again, your Arby's or something might be, 5, 10, maybe a little bit longer in years, but you're talking about leases that are on the order of magnitude of 20 or 30 years, correct?
Right.
Is that, again, industry standard, or is that basically something where you found that as a sweet spot to get in, get something seasoned, and then again, turning around for the reposition is, a 25-year lease versus a 15-year lease length of term left more attractive for the person that you're trying to flip this to? So what are kind of some of the things that go into determining length of lease, or is it kind of standardized for the industrial space?
Yeah, as a landlord, I've always known that lease does nothing more than protect the tenant, right? The tenant's going to leave whenever they're going to leave, when in the residential world, and
Yeah.
there's not much I can ever do about that. Me as a landlord, I can't kick them out until that lease is over, because so it puts a lot of onus on me. That's a little bit cynical at this point because I've had to deal with some of those scenarios as a landlord.
Yeah.
But on the commercial side, these are well-funded, deep-pocketed tenants who know they have to honor that lease, right? The only way out of that lease is a bankruptcy proceeding, or unless they completely dissolve as an operation. And so the value of that property is in the length of that lease to a strong tenant. And so 20 years is pretty much industry standard. We'll push out as far as we can get, 25, 30. That's if we can get them up to that level, that would be beneficial to us. Typical is more 20-year lease. And so then when we resell the property, again, it's if there's 3 years left on that, that's a big risk for the purchaser of that building, because if that tenant does decide to exit that building or that property, that's going to be a property that may be difficult to release based on how much customization happen there. And so if we can sell that to a tenant or to a purchaser with 17, 16 years left on that lease, that's a long time for them to execute their business plan, the buyer of the property from us. And so the length of that lease is critical. And so that's when this transaction happens, it's going to be a brand new 20, 25 if we can get it, year lease. We're going to sell it in 2 to 3 to 4 years. Anytime there's a capital improvement requirement, we're going to step in there and offer to finance that and to take care of that improvement in exchange for resetting the clock on that lease. We're going to do a brand new 20 or whatever that starting clock was, year lease on that property, and that just makes that property that much more easy and valuable for us on the sale.
Is it kind of safe to assume from what you're telling me, and this is kind of what I'm picking up from that, is that typically, obviously, industrial tenants rarely move, but the catalyst for them moving is typically the end of the term of the lease is when most of the time those moves happen, because breaking an industrial lease, I'd imagine is, it's kind of like, it's going to court. Like, there's it's a huge headache in one, them having to find another place that fits the bill, but two, the expense in doing it. I would imagine that most of these types of businesses only move when leases are up by the natural course of their lease. Is that a kind of a painting with a broad brush assumption?
Yeah, and even generally, once that lease term is nearing expiration, they're looking to release because it would be a huge expense for them to relocate. But that's their opportunity to do so. If they're going to consolidate operations, they want to get out of this site. That the end of the lease term is their opportunity to do that without court proceedings or bankruptcy or what have you. Thinking about retail, malls come and go. Right, you have good parts of neighborhoods, and those can come and go, and so that can be a risk at times where a tenant might say, "All right, this part of town is dead now. We want to go over to that new shopping mall over here. Everybody's shopping at that one now." But in the industrial sense, in the industrial world, they don't care about foot traffic, right? They care about having employees, a skilled workforce in the area that can help them build and get done the things that they're looking to accomplish in that site. And they might be the largest employer in town, and 50% of the people there work for this firm building these things in that plant. You think about the cement manufacturing plants. You've done long road trips and you've seen that weird looking plant 5 miles off the road. Like, what are they doing out there? That's the kind of building that we're going to buy, right? That's because it's out there in the middle of nowhere. We don't care about geography. That employers invested a ton of time and expense into that location. They've got the workforce in place. It's a town that's kind of thrives around that operation. They're not leaving, right?
Yeah. The metal foundry doesn't care if the Whole Foods closes.
Exactly.
Like, okay, great.
Right?
We're still smelting iron. It's and Whole Foods can come and go.
Exactly. It doesn't impact them.
Yeah, we've covered a lot of the thesis stuff, and I'm kind of having to steer myself because I know my producer's going to jump in if we kick this thing past 45 minutes too far. So we've kind of covered, again, the ins and outs, because a lot of people really just don't know kind of the ins and outs of the industrial world. But let's talk about from the investor side of things. So this is kind of, again, outside looking in, we've covered, what does industrial look like? How does that differ from X, Y, and Z? But you mentioned kind of at least how you operate. And again, this is, again, if this is industry standard or if there's kind of a lot of different variants in this, you can touch on it or not. But you mentioned that you kind of have two different avenues of investing from the outside. We've covered how you identify deals, but from the outside investor, let's say I wanted to come in and invest, there's kind of two different routes that you have. One, and again, correct me if I'm wrong, by all means, but you have kind of a pooled investment fund where you have investors coming in that plug in, I would assume, as limited partners with a X amount of lockup to their investment, and maybe kind of cover some details about how that differs from. Then also you have a more REIT structured investment as well. Now, is that all packaged within the same investment fund? Are they carved out separately, or is it an election you make when you initially invest? Let's kind of look at it from the investor coming in from the outside of how they can kind of plug their capital into these types of offerings.
Yeah, perfect. So I'm a broker dealer representative. I'm a licensed securities broker, and so that means I have to get to know my potential investor really well. I have to be able to recommend something suitable to them. Where are they at in life? What are their goals? What's the family dynamic? What's their experience level? What are they trying to accomplish here? And so that's going to steer me, help me guide them towards what I would going to propose to them. Is that going to be maybe swinging for the fences a little bit more with a self-storage or multifamily play, or a specific class within those, or this industrial fund where it is really predictable, steady cash flow, that can be really attractive to somebody a little older, or somebody who's more conservative. That can be really attractive to those folks. And so then we, talking if this looks like the suitable route for them, we also have to look at what does your tax situation look like? If that's I don't want to put an unnecessary burden on this individual who maybe writing a $50,000 check is they could do one of those every 5 years. And now having to come in and do 10 state returns, that's going to be a big burden on that individual. And so again, wanting to get to know them and their situation, what are they doing each year for their taxes? How complicated is their tax return now? The direct ownership allows for some of the tax benefits that come from ownership of real estate that you lose in REITs. It's one of the reasons people go with private entities versus public REITs, because of the direct ownership providing those tax benefits. So if you're looking for the passive losses or the other deductions that can come from direct ownership, you're not investing through your IRA, you need those tax advantages, then maybe that direct ownership is the way to go. If that's not important to you, let's go the REIT route, and now it's just going to come in one single statement when you're not impacted by the state return requirements, and you're done. And as far as how that's done, it is actually the same fund. It is actually just a simple election when you're completing your syndication paperwork or the private placement memorandum that we provide.
Now, depending on how, at least that y'all operate, is the lockup the same for a new investor, whether they're doing with the REIT route or just the direct ownership route? Because I know REITs have a tendency to be highly illiquid and kind of hard to get out of in general. And I'm the first one to admit I am a big novice when it comes to the REIT world. It's just not something that, the uncapitalized REIT market just doesn't bleed into what I do. And, the publicly traded stuff, obviously we don't handle. So,
Sure.
what's kind of the difference from an investor standpoint? Again, is it mainly just on that taxation consideration as far as how, again, the general things that most people want to know is, hey, okay, what do my returns look like? How liquid is this thing? What does that look like? So again, is the lockup the same for a new investor coming in, depending on which one, or is it differ depending?
In these private investments, yes, the lockup is the same. Generally, when we're talking about public REITs, if you log on to your Schwab account, your Fidelity account, you could buy a public REIT in the morning and sell it in the afternoon, right? Very, very liquid. When we're talking about the private syndications, these private securities, if you go the direct ownership route, you're going to be with us for the duration of the property, right? 5 to 7 years is typical. And if you elect the REIT option with us, it's still a private security. You're going to be with us for the duration of the project. And so in a private security, you are under that same lockup period. Again, the public REIT option that provides liquidity for good and for bad, but there's definitely pros and cons to the liquidity conversation. But yeah, that's in our scenario, it's going to be the same lockup period regardless of the route that you take.
Gotcha. And with regard to kind of how the returns are paid, is it basically kind of similar to what you do in the commercial multifamily space, where there's like an 8% pref and then there's like a 70-30 split after that? Does it turn into a return of capital versus return on capital after a certain threshold is met? With regard to the industrial side, how does that differ? Or is it all kind of generally the same, at least with regard to kind of like the syndication aspect that most people might be used to? Maybe we'll compare and contrast on how that works.
Yeah, very, very similar. And many of our multifamily deals will have multiple classes. In the industrial opportunity, we're doing just one single asset class. And we've put in there a preferred return, which is really tied to what we expect to be able to generate from these lease terms that are already known, and the lease increases that are going to happen over the next several years. So far, we're 3 quarters into this fund, and each quarter we've been able to exceed those projected returns because it's been performing well. And that's that's the cash flow that you'll receive during the life of the fund. And then as it's not going to be a first in, first out type. It's not going to be that clean. But along the way, the buildings have been acquired. They're going to sit in this fund for 3 to 4 to 5 years, and then at opportune times, individual properties will be sold out of the fund. And when those capital events happen, there's going to be a distribution to the investors. And that's calculated upon again a very similar scenario to the multifamily scenario where there is the waterfall structure. We're talking about return on capital, trying to perform well for these investors, so that cash flow projection is solid, bankable. I'm not going to say guaranteed, right? I can never say that, but really consistent. And then when those capital events happen, we'll be able to deliver some icing on the cake for the investors as well.
Yeah, absolutely. And I always, you echoed it, but I'd like to very much hammer home the fact that, when we're talking about this stuff, and yes, it may sound great to, hear something has been exceeded, but always do your due diligence for anyone listening out there, especially if you're new to this space. Research, do some more research, make sure you feel comfortable. Investments like this do have, again, we talk about things like lockups. You are going to be locked into something for, a duration of a project. That might mean you can't get your underlying basis out for 5 years. Granted, it may have get cash flow, but, make sure you're okay with something being illiquid, especially in this space. Again, my 2 cents on it. I always like to make sure the main reason we do this is one, to increase our reach and to bring great information. But a big component of what we believe in, and personally myself, is education. Make sure people understand how this stuff works, and that you're comfortable in understanding what you're getting into. But that kind of brings up to our 45-minute mark. Brad, I really appreciate you being on here today. I always really enjoy these when I get to learn something. I hope our listeners get to learn something from every podcast that we do. But I really enjoy getting to learn new stuff, and I really didn't know my head from the hole in the ground when it came to the industrial side of things. So I do really appreciate your time being on with us today to educate not only myself but our listeners. Now, if people want to get more information about how to kind of invest in maybe what you have going on, or maybe learn more again on the topics that we've covered, how can they get in touch with you and Sugar House Investments as well?
Yeah, thanks, Alex. And I appreciate that. That means a lot coming from you, because I know you're an expert in this field. But the best place to connect with us and to learn about industrial opportunities, as well as all the opportunities that we have available to our investors, is at our website, sugarhouseinvestments.com. That's there you can kind of get to know us a little bit, see the team, and put your email address in there to be able to see the new deals or the existing deals as they come up. We like to give our return investors, our current investors, kind of the first shot at new deals as they come along, because they do oversubscribe pretty quickly. And so one thing I'll offer to your listeners is if they go in there and mention your name or your podcast name, letting me know that they heard of Sugar House through you, we'll put them on that VIP list, and so they'll get those notifications first before the main group of our email subscribers do.
Fantastic. Well, we certainly really do appreciate that. Again, this has been the Alternative Investing Advantage podcast. I hope everyone learned something today. I know I did. Thanks very much for joining with us, and we'll catch you on the next one.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.